All right, everybody. Thanks for joining. Welcome to today's webinar. I am Noah Dreyfus, the Chief Investment Officer of Dreyfus Capital Management. Along me is Greg Drozdow of Drozdow Financial. We will be discussing today the implications of the debt ceiling and U.S. debt issues on the economy and how it may affect investors. Just for disclosure purposes, this content is just for informational, educational purposes only. So any investment decisions investors decide to take on their own outside of the scope of this as a result of this webinar is not the responsibility of Dreyfus Capital Management, nor is it the responsibility of Greg Drozdow with Drozdow Financial. With that, Greg, do you want to come on and introduce yourself?
Yeah, sure. Thanks, Noah. Appreciate it. I'm Greg, again, Greg Drozdow. Drozdow Financial is the DBA of our Registered Investment Advisory Group and firm, Certior Financial. And first and foremost, I guess a little bit of background. I'll be moderating today, and we're looking forward to getting into an in-depth discussion about what is going on, a little bit of a market update, the debt crisis, how it affects interest rates, Social Security, and a few other areas, and we'll leave open for Q&A at the end. So why don't we go ahead and dive in and get started? So Noah, first and foremost, why don't we start by explaining what is the debt ceiling?
Yeah, that's an excellent question. So the U.S. government and Congress approve a budget every year that includes spending across all areas of government. That will include entitlement programs such as Social Security and Medicare, defense spending such as military, infrastructure such as repairing highways, building bridges. The government approves this spending not knowing how much tax revenue is going to come in from individuals and corporations at the end of the year. This means that if there's a deficit or the tax revenue that's collected through income taxes doesn't meet the obligations of the approved spending that Congress has passed, the government will end up having to issue debt in order to cover that gap or that margin that is not covered by the tax revenue. So the debt ceiling is a limit that the government places on the amount of debt that can be issued in order to finance government operations not covered by incoming tax revenue.
Got it. Thank you. Thank you. So can you briefly explain why the government would place a limit on the debt it can issue?
Yeah, so this is kind of pivotal to what's coming up right now. The more debt that the government issues, the more debt expense in the form of interest it has to pay. And so over time, the debt expense can eat up more and more of the tax revenue that comes in. So let's say, an example, $1 trillion of tax revenue comes in, but the debt expense keeps incrementally going up from 1.2 to 1.4 to 1.6 trillion. The less the government has actually to spend on the programs that it has approved spending on. So over time, this debt expense can eat more and more of the tax revenue, and that exacerbates the issue. The more debt expense incurred, the more tax revenue is spent on just covering the interest payments, the more debt the government has to subsequently issue to cover increasing deficits. And that's what's generally called a debt spiral.
Okay, gotcha. Thanks for clarifying. So Noah, can we talk for a few moments about what led into this issue? The past few years, we've had a whirlwind in terms of concerns in the markets. First, we had COVID, which caused a flood of money printing. We had inflation, which caused the Federal Reserve to raise interest rates. And concurrently, we've had ongoing geopolitical concerns like Russia and Ukraine. And then finally, we've recently had the collapse of several major banks in the U.S. So, Noah, can you give some context as to what led to this debt crisis of 2023 right now?
Yeah, absolutely. So the most important issue to understand here is how interest rates and debt affect different aspects of the market. This is a complex issue and hard for non-professionals to fully understand. Once we fully understand how interest rates affect markets, then we can kind of understand the snowball effect of the past few years.
Okay, so where can we start from?
Yeah, the first place to look for clarity in how inflation works and interest rates work and how central banks intervene in the markets. In order to understand that, we have to first understand how currency works.
Originally, currency was issued by countries minting coins. Eventually, they ran into a major problem. As societies became larger and trade, especially international, became more and more common, countries couldn't access the required amounts of precious metals in order to mint coins. As a result, they began issuing fiat currency, or paper money that represented value but had no intrinsic value. The issue with paper money was that governments theoretically could print as much money as they wanted. Let's say one note is the current price for both a loaf of bread and a bottle of wine. While a note today can purchase a loaf of bread or bottle of wine, if the amount of notes in supply increased tomorrow by 20%, then it would take 1.2 notes to purchase the same loaf of bread or bottle of wine. If the local baker accepted one note for the bread today, then he would have to come out of pocket an extra 0.2 notes to buy wine tomorrow. This is called inflation. For this reason, paper money historically has followed a precious metal standard. This meant notes or paper money could be converted to a standard metal, typically gold or silver. If a country wished to print new notes, it would be required to acquire enough quantity of a precious metal to exchange for the fiat currency. This created a disincentive for printing money. In practice, a traveling merchant could sell his goods for the local paper currency, and at the end of his trip exchange the notes for precious metal to exchange for other goods upon his return to his home country.
All right, thanks for being patient with that animation there.
Yeah, thank you. That was great. So if I understand correctly, inflation is partly connected to government printing money, right? And the increasing the amount of money circulating. So this historically has been solved by allowing for the exchange of money into precious metals, like the video just showed. However, this is no longer the case, as we know the dollar is no longer backed by gold. So how does the government currently control inflation?
Yeah, absolutely. So that's an excellent question. There's a couple of different methods that the government controls inflation. The Federal Reserve mostly controls inflation through a few blunt tools, the primary of which is interest rates. So let's go back to understanding inflation due to money printing. The issue with fiat currency is that unlimited printing of money increases the supply of money in the system. This leads to increased spending. And so increased spending and demand leads to suppliers increasing the price of goods as demand goes up. And so one way that the Federal Reserve can control inflation is by controlling spending. If interest rates go up, then people are more hesitant to spend money on credit to buy goods and services and real estate. So if mortgage rates go up, you're more hesitant to buy a home at a higher interest rate than a lower interest rate on a mortgage that you might have purchased 3 months ago. And so this is one way the Federal Reserve controls the flow of money and therefore controls inflation.
All right, awesome. Thanks, Noah. So by controlling the credit usage, we can affect the rise in the price of goods. What about issues in the supply chain? For instance, let's say a supplier now manufactures goods in the US versus outsourcing to China. Or let's say a business owner or business owners have to pay their workers higher wages because of labor supply issues and sustained inflation. How does changing the interest rates affect cost inflation?
So the truth is it doesn't. There's another tool that the Federal Reserve uses called quantitative tightening. The simplest way to understand this is that banks hold customer deposits and are allowed to invest a portion of these deposits by issuing mortgages and loans. And so let's say a bank buys a 2% bond and pays their customers 0.25% in interest for holding their deposits at that bank. Well, the bank is taking 1.75% in interest off of that deposit. That may not seem like a large amount for most folks, but when you pool together a whole bunch of money from a lot of different people, that can add up into the billions of dollars. And so now COVID happens and the Federal Reserve comes along and offers to buy that bond at a premium to what the bank paid for it, or buy that mortgage off of them. The bank then sells that mortgage and now has cash to lend businesses or people for another mortgage or investment. And so this causes an increase in the money supply when the Federal Reserve takes those mortgages and those bonds off of the bank's balance sheet. However, in reverse, if the Federal Reserve sells bonds to banks, then the bank has less cash to lend out, thereby restricting the flow of money, and businesses that have higher costs are forced to forecast and predict the flow of money in determining how much they can spend when their costs are higher. And so this leads to decreased inventory levels in businesses and decreased spending on such things like onshoring manufacturing. And that leads to an aggregate decreased spending. So the economy starts to slow down.
Thank you, Noah. So now that you've explained how the Federal Reserve uses interest rates in the economy, can you tell us a little bit about what happened to the banks in Silicon Valley, or really like the Silicon Valley Bank?
Yeah. So what happened is generally called duration risk, or the risk of existing debt that an institution holds being affected by interest rates rising. So let's give kind of an example to what that looks like.
Bonds are loans where the lender and recipient of interest is the investor and the recipient of the capital funds is the bond issuer. In the past, investors bought individual bonds as a safe haven to protect assets from stock market volatility. Since loans pay fixed interest, investors consider them safer than stocks. Let's take Fred for an example. Fred is retired and relies on income from his investments in order to cover his expenses in retirement. Fred likes the security of bonds, especially in the middle of a recession, and in March of 2020 buys $10 million in 10-year U.S. Treasury bonds paying 1% so he can generate $100,000 in income. Since bonds are usually sold in $1,000 increments, Fred has to buy 10,000 bonds at $1,000 a bond. In practice, Fred has now loaned $10 million to the U.S. government. Fred gets only 1% because the economy hasn't been growing very much since COVID started and the Federal Reserve lowered interest rates. Fast forward 1 year and the economy starts to grow very quickly as the world begins to go back to normal. People are spending money again, traveling, buying homes, and prices begin to rise rapidly.
And so Fred buys this single U.S. Treasury. Let's say Fred were to buy a single U.S. Treasury bond for $1,000 in 2020 at an interest rate of 1% for 5 years. That would yield him $10 per year, or in total $50. If the Federal Reserve were to raise interest rates like they did to, let's say, 4%, well, a new bond that is issued in the market is going to pay $40 per year. Now, Fred needs to sell his bonds in order to cover his grocery expenses, which have risen 20% due to inflation. Since the going rate for Fred's bond is now 4% in interest, which pays $40 per year, and Fred's bond only pays $10 per year, no one will buy the bond for the $1,000 that Fred paid for that bond. And so what has to happen is a calculation. We take $40, which is the rate of interest on the new bonds. We subtract from that the $10, we get $30 in missing interest here. Well, $30 over 4 years remaining on the bond is $120. So if Fred wants to sell his bond in 2021, he's got to take $1,000, subtract from it $120, and then he's left with selling the bond for $880, or roughly a 12% loss.
Got it. And I guess can you explain, Noah, how this would apply with an institution as well?
Yeah, so the same thing can happen with an institution. Let's give another example there. So let's say we're just speaking theoretically. There's a bank called SVB, and they get $10 billion in new deposits due to the Federal Reserve lowering interest rates roughly to zero. And then venture capital firms flood all these up and coming startups with cash that the venture capital firms borrowed at 0% rates. Well, this SVB bank goes ahead and says we have $10 billion in new deposits. We'll take $9 billion of that and purchase 10-year treasury bonds that pay 1.5% in interest in 2020. Well, that equals for the bank a net income of $135 million per year. And so, but what happens now that the Federal Reserve has raised rates to 4% in 2022, and SVB Bank has all these 10-year bonds on its balance sheet? Well, the startups that were funded with the $10 billion in 2020 can no longer raise as much capital as before because interest rates are higher. And they begin to burn through the cash that they raised back in 2020 in order to survive. And so now SVB's bond, $9 billion in bonds, which pay a total over the life of the bonds, $1.08 billion in interest for the next 8 years. Well, if someone were to buy $9 billion in new bonds, they would get $360 million in interest as opposed to $135 million in interest. So we do basically the same calculation. We take $360 million, which is what you would get at 4% on $9 billion in bonds. We subtract from that $135 million, which is the interest rate that SVB bought their bonds at, and we are losing every single year $225 million. And so $225 million over the course of 8 years equals $1.8 billion. So now the value of SVB's bonds is no longer $9 billion, but it's actually $7.2 billion for a $1.8 billion loss. Now, SVB, the reason they need to sell these bonds are because all these startups that deposited the money in the first place are withdrawing all that cash for payroll. So they actually SVB now needs to generate cash in order to fund that payroll. And when the market realizes this and all their depositors realize that they're selling these bonds at such dramatic losses, everyone starts to pull their money out, and that causes an insolvency risk to the bank.
Got it. Thank you. Great explanation. So obviously, I understand when it comes to banks that this is a big issue, but what about businesses that don't buy bonds? So how are they affected by a rise of interest rates? For instance, the entire tech sector last year fell pretty much in uniform fashion as interest rates rose, and the market didn't differentiate between profitable tech or unprofitable tech. And companies such as Microsoft, Google, Apple, they fell about 20%. So what happened there?
Yeah, so that's a great question. The answer is dynamic, as there are a bunch of moving parts. The first part is that a lot of tech companies rely on business-to-business commerce. And so companies like Microsoft make a bulk of their revenue selling software packages to businesses. And when lending is cheap and interest rates are low, smaller businesses are able to access capital easily, and therefore they spend to expand their businesses, increasing the packages that they purchase from a company like Microsoft. And so if the loans they take have interest rates that rise rapidly, or their funders slow down investing capital in them, they're unable to expand and spend less on tech from other companies. So even a company that relies on business to business sales and has no debt will have a downturn in this type of environment. The second part is the US dollar. So when interest rates rise, the government signals confidence that the economy is very strong and needs to cool off to get back to normal. This means that the confidence is high in the government collecting taxes because the economy is doing really well. GDP is expected to rise. And so when that is the case, governments all across the world have to buy US dollars and to enforce confidence in their own currencies, which are going down compared to the dollar. And so a lot of tech companies, in the instance of Microsoft, will sell those packages internationally, and they collect revenue in the local currency that that country is purchasing that package from. And so when the dollar goes up in value, their currency falls in value. The revenues reported back to Microsoft are often look a lot less than they were a few years back down the line when the currencies were more level.
Got it. Okay. So let's say a company issues debt in 2020 at low rates, and the amount of cash raised is enough to last them for, let's say, 5 years. They sell most of their products domestically and are relatively inflation proof. Are they also at risk?
So it really depends on their profitability. There's this kind of theme that's been coming out over the past 15 years when interest rates were relatively low of something called a zombie company. So in reference to your question, when they have to refinance their debt, any debt they issued at low interest rates will have to be refinanced. So let's say in a case where if it was debt that was issued in 2020 at 0% interest rates, or let's say 2% interest rates, and that was a 5-year term on that debt, they're going to have to refinance that in 2025. The likelihood is that the cost of refinancing that debt is going to be higher than what it was in 2020. So let's kind of take a look at an example here. So let's say take ABC Cruise Companies. So everybody remembers prior to the pandemic, cruises were very popular, and then all of a sudden in 2020, they kind of shut down. So let's say in 2019, ABC Cruise Company came up with a profit at the end of the year of $5 million. And the total amount of shares available on the market, because all shares of companies have a limited supply, that's what makes them valuable, is, let's say, 10 million shares. So if the share price is $5, that will we times that by 10 million in order to get the total value of ABC Cruise Companies at $50 million. Well, let's say ABC comes up with a clever way of increasing their stock price from $5 upward. What ABC decides to do is they sell debt for $25 million total, or roughly 50% of their value at 2%, because interest rates are very low. And they take into their accounting that the cost of that debt is only $500,000 per year. Well, that's only 10% of what their annual profits are at $5 million. And so that's an affordable expense for ABC Cruise Company to take on. They then take that $25 million and they buy back 2.5 million shares, or 25% of the total amount of shares available in the company. Why do they do that? Because the company is still valued at $50 million today. And so if they decrease the amount of shares available in the market for that company from 10 million down to 7.5 million, well, now we need to readjust the value of each share. So if there's less supply of shares, then the shares available in the market become more valuable. The way we do that is by taking $50 million, which is the value of ABC Cruise Company, divide that by the amount of shares available in the market, which is 7.5 million. And now the stock price rises from $5 to $6.66, or roughly a 33% increase. Well, a few years go down the line, and now 2025 comes around, and let's say the Federal Reserve hasn't lowered the interest rates, and now ABC Cruise Company is stuck in a situation. They have to refinance all the debt that they issued at 2%, now at 12% interest rates, which means their annual debt cost of that $25 million is now $3 million, jumping up from $500,000. Well, because of the pandemic, people aren't going on cruises as much, and ABC Cruise Company's profits have dropped 45% from $5 million to $2.75 million. That means that, in essence, their $2.75 million profit is weighed against their $3 million debt, and now ABC Cruise Company is no longer profitable at all. So this is a concept called a zombie company. There are more than 600 US companies that are defined as zombies, meaning the amount of revenue that they accrue every single year may not outweigh the amount of debt expense that they have to pay back to their creditors.
Okay. So, understanding this, any debt owed by a person, institution, or country could be at risk when interest rates rise dramatically. Also, the value of international commerce falls when the US dollar rises. Can you tell us about how this affects governments?
Yeah, so unless the government is running a surplus, which it hasn't done since the Bill Clinton era, and governments rely on debt markets to fund their spending, like we covered before. So currently, the US government runs a $1.4 trillion budget deficit. That's as of fiscal year 2022. This means that in order to fund its existing obligations and spending already passed in Congress, the US needs to issue $1.4 trillion in debt every single year. Now, that's assuming that the tax revenues stay the same as they were in 2022. If a bad recession were to happen, this deficit would increase, and because the tax revenues from people and businesses that the government is collecting goes down when the economy goes into recession. And so therefore, the deficits could actually increase further, based on that happening.
Okay. So how would this obstacle of raising the debt ceiling impact investors and the economy as a whole?
Yeah, so the impacts would be wide-ranging. The first impact would be that U.S. government bonds, they have a credit rating. So that credit rating would be re-rated down by the ratings agencies. The impact of that is that U.S. Treasury bonds would be worth existing U.S. Treasury bonds that people hold would be worth dramatically less than they are today. And interest rates would spike as a result because the ability for the government to now issue debt and guarantee their creditors that they'll pay them back that risk is now increased. Other impacts would include a stock market sell-off, a dramatic fall in the value of the US dollar, and inflation would spike upwards. The ability of the US government to borrow money would be greatly depreciated. This would mean that the deficit would increase, impacting Social Security and other government programs, entitlement programs. Given that the Social Security fund at current debt levels is forecasted to be depleted in mid to late 2030s, this is potentially a very serious outcome. It also could mean that the US dollar will cease to be the international trade currency, which will impact numerous forms of global trade.
All right, so that leaves me with a few questions. So first, why would inflation spike if the US government defaults on debt?
Great question. So since the US dollar's value is tied to the faith that the US government will pay its debts and obligations, if the government were to default on its debt, this would lead to a lack of faith in the US dollar. A lot of countries hold US dollars as a backup or peg to their currency and would likely flood the international market by selling their US dollar reserves. This would cause the supply of US dollars in the global system to spike. And it's because its supply spikes, as we covered before, the value of it falls. And so let's take a look at what's happening to the US dollar right now. Top of the market for the US dollar back in October, we have fallen roughly about 20% without even a default in the government debt. So this is the anticipation of central banks essentially flooding the market with the global market with US dollars. And so when the US dollar falls in value, its ability to purchase goods falls. So let's say I'm a person buying something from China, I'm a business buying goods from China, and my US dollars are now worth less. That means I have to pay more of them to the manufacturer in China to get my goods imported. That could cause prices to spike.
Okay. So, thank you. So you mentioned also that the Social Security fund, even prior to default, is forecasted to be depleted by mid or late 2030s. Does this mean that retirees will not receive Social Security?
That's a great question. So the answer is most likely not entirely. Social Security is funded by an income tax. And so this income tax currently covers about 80% of Social Security payments. The other 20% comes from the Social Security Fund, which supplements those payments and is a pool of investments, typically in government bonds. If the fund were to be depleted and income tax revenues remain constant, retirees may face, in that circumstance, a 20% reduction in payments unless Congress intervenes.
Okay. So I guess that's somewhat of good news. While it may not be completely depleted, right? A slight reduction is better than nothing. Let me ask you, I think the question that we're all wondering, you mentioned a few different areas of our economy that could be significantly potentially impacted by this. Do you believe that it is likely that the U.S. will default on June 1st?
I do not believe it is likely. The consequences of a default, and we only covered a small number of them, and on a bird's eye view of them, would be so dramatic that you would be hard pressed to find a single person in Congress that would vote against raising the debt ceiling that would be able to keep their seat in Congress. And one thing I do have faith in Congress for is them wanting to keep their seats. So that's why I do not believe it is likely that the U.S. will default on its debt by not raising the debt ceiling.
Awesome. Thank you, Noah, for sharing that perspective. So I guess a more important question even, how should investors position themselves currently? Are there ways to invest that will hedge against a US default without exposing themselves? Should the debt ceiling be raised?
Yeah, so there are several ways to hedge against a US default. International stocks, emerging market debt, gold and silver, technology stocks can all be potential hedges against the US default, while there's no guarantee for any of them to act as such. And so that being said, not all of these will improve regardless of a default. Ultimately, investors should hedge themselves in such a way that even if the US doesn't default, their hedges improve because of market dynamics and a long-term investment philosophy.
Can you elaborate a bit on that, on market dynamics and long-term investment philosophy?
Yeah, so Dreyfus Capital is both an individual investment advisor to folks that need help with retirement planning and growing their investments. We also are running a fund which essentially provides those asset management services to other advisors. So I want to thank all the folks from Drosdow Financial and Circular Financial Group that use my services with Dreyfus Capital Management. Currently, we hold hedges in technology stocks and gold and silver funds, amongst others. While it is not within the scope of this conversation to cover individual positions, gold and silver are alternatives to holding currencies. So we covered before, if currencies fall, gold and silver are typically inversely have an inverse relationship or do the opposite of whatever currencies do. And so when fiat currency is in question, the demand for precious metals increases. So let's take a look here at the chart of gold and silver compared to the dollar. Here, what you see in the purple line is the value of the US dollar as we looked at it before. And what you see here in the red and green line is behavior of the price of gold per ounce in US dollars. So what you'll see kind of here is that they're acting in the exact opposite fashion. So one way to hedge against the US dollar falling is by purchasing gold. Now, within that, it's not within the scope of this conversation to make investment recommendations. And like we discussed before, neither I nor Greg take any responsibility in that recommendation, and investors should consult with their financial advisor. And if they don't have one, they can consult with one of us. But before taking any investment decisions based on what is discussed today. Also, many tech companies selling their products abroad have had their earnings cut due to the dollar rising versus other currencies. Remember, we said that Microsoft, for example, sells a software package in Europe. If the euro is falling and the dollar is rising, then Microsoft is going to get less value out of those euros that people in the European Union are paying. And so if the dollar were to fall dramatically, this could improve their earnings as the value of their services being sold internationally would go up instead of going down. I do want to restate there's no perfect hedge. And so any of these optionalities that we're discussing may or may not behave in that manner. However, even if the US does not default on the debt ceiling, the debt issues currently in this country should benefit stocks of companies that have enough cash to pay off their debt entirely. So if I'm a very profitable company, I have very low debt levels and interest rates continue to go up, or there's a potential debt crisis. Well, if I have enough cash as a corporation in my bank account to pay off that debt, then investors in the market will value me at a higher premium than other stocks simply because I have that cash buying power, if that makes sense. So the debt issues will also will likely devalue the US dollar, as the deficits we are running are just too high and must be solved eventually. This should benefit precious metals and the technology sector, amongst others, at least for the medium term horizon. Investors should remember that long-term investing is a discipline in buying good companies that have solid balance sheets, long-term growth horizons, and benefit humanity. Hedges are ways that investors can mitigate market risk in the short term, but should not distract from long-term investing in, like I said, good companies, solid balance sheets, long-term growth horizons that are generating products and services that benefit humanity.
Awesome. Thank you, Noah, so much. This was great. Every time I hear you speak, I learn something new. So I hope everyone here has gotten a lot of value out of this. This has been very informative. And we're going to open it up for Q&A. I see we do have a question. How does investments in tech stocks hedge against a devaluation of the dollar and or US default?
Yeah, absolutely. So while it doesn't necessarily hedge against the default of the US dollar, it does hedge in a certain way against the value of the US dollar falling. And so think about it this way. We gave an example before. Let's say Microsoft, they're selling their software packages internationally to people from Europe, to Asia, to Latin America. And when the US dollar falls, the value of other currencies in the world rise to reach an equilibrium. So the value of the payments that are made for their services and software packages that are sold in Latin America, that are sold in the European Union, actually rise in the event that the US dollar falls. And that's part of the reason that I believe you've seen the US dollar falling and the tech sector being the best performing overall sector in the market this year. So let's kind of take a look back to this. This is the US dollar that we covered before. Let's add a layer onto this and let's look at the overall tech sector. And you'll see when the dollar was rising all of 2022, the tech sector was falling here. But now that the US dollar, right at the point that the US dollar starts to fall in value, you see the tech sector start to rise up in value. So that's that inverse relationship that I was talking about. Ultimately, there's no perfect hedge like we talked about before, but that would generally be one of the reasons why the technology sector can be a hedge against the fall of the US dollar. Regardless of a default or not, the US dollar should continue to fall in the medium-term horizon based on our debt issues and lack of a solution for them.
Great, thank you. Do we have any other questions? Speak now or forever hold your peace. No? Okay. Noah, before we conclude, why don't you share, if you can, where if anyone does have questions, we're going to send out a recording of this webinar. But if people do have questions, how can they contact you?
Yeah, absolutely. So my website is dreyfuswm.com. I'm going to put that up in the chat here. And if anybody wants to contact me, my email is noah@dreyfuswm.com. Greg, do you want to share your contact information?
Yep, I'll go ahead and do that. So I'll put down my email here. If anyone on here is looking for, general financial guidance, advice on investing, retirement planning, tax strategies, our firm, Certior Financial Group, can assist you, can guide you. Again, Drosdale Financial, my company is a DBA of Certior Financial Group, and we look forward to supporting you with whatever questions you have. You can feel free to reach out to myself or both Noah and I, and we look forward to speaking with you and helping in any way we can. I think that wraps it up pretty much for today. This was a great presentation, Noah. Thank you again. And we'll keep your eye out for an email coming from us with the recording, and we look forward to seeing you on future webinars with us. Thank you.
All right. Take care, everybody. Have a great day.